Okay, so let's get into this. We've all seen it, right? Some kind of financial madness, whether it's the latest crypto thing or a housing market that just seems to defy gravity.
Mm-hmm.
And you always have to ask the same question. Why do we keep doing this? Why do we, as a species, just cycle through the same pattern of, enthusiasm, delusion, and then crash?
It's a fundamental
Have
question,
you?
and not a new one.
Not at all. It reminds me of that quote from the poet Francis Quarles. Way back in 1635, he wrote, "What's lighter than the mind? A thought, then thought." This bubble world.
This bubble world, I mean, that captures it perfectly. The idea that our whole financial reality is just fragile. It's a thought waiting to pop.
Exactly. And that fragility, that recurring madness is what we're digging into today through one absolutely definitive
You're
work.
right. We're using Edward Chancellor's Devil Take the Hindmost, a history of financial speculation as our guide.
And our mission here is really to use this book as a blueprint. We want to pull out the common threads, the psychological ticks, and the structural setups that drive these booms and busts, all the way from ancient Rome up to, well, right now.
And what's so fascinating, what Chancellor lays out so well, is that modern speculation isn't new. It's built on these fundamental blocks that were laid down centuries ago.
You mean like legal structures?
Yeah, exactly. The prerequisites for capitalism, you see them taking shape in the Roman world, the free transfer of property, lending money at interest, primitive forms of credit and insurance, all that.
And the Romans were famously obsessed with wealth, right?
Yeah.
Accumulating it, showing it off.
Oh, absolutely. A very visual culture of consumption. But it's interesting how they talked about the people who actually, played the markets.
They had a specific term for them.
They did. If you were a military lookout, a sentry, you were a speculator from the Latin to look out or observe.
Ah, so literally an observer.
Right. But the financial guy, the one chasing profits in the market, he was called a quaestor, a seeker.
A seeker. That's a very different vibe.
A very different vibe. And the conservative elite would sometimes dismissively call them Gracie Greeks, implying they were doing something a bit distasteful, not quite Roman.
Wow. And where did all this happen? Where was their Wall Street?
It was all centered in the Forum, right near the Temple of Castor. That's where the crowds would gather to buy and sell shares and bonds.
And I'm guessing the same attitudes about risk existed back then, too.
Completely. Conservative men, the establishment, they avoided buying shares in the public companies, the publicani, because it was seen as just a gamble.
So it was already looked down upon.
By some, yes. The great orator Cicero even mentioned partes carissimas, the most expensive shares, which tells you that even in antiquity, people were piling into overvalued assets just because they were popular.
The same story, just 2,000 years ago. So the psychology is there. But for it to really explode, it needed something more, a structural shift.
It did. It needed state borrowing on a massive scale. And that brings us to the 16th century and what you could really call the world's first junk bond mania.
Okay, so now we have governments getting in on the action.
Exactly. This fever for royal loans spread across Europe, especially in places like Antwerp and Lyon. And the person issuing the debt was literally the king.
And the best example of this, I think it's King Henry II of France, right? The Grand Party loan.
That's the one, 1555. It promised a return of 16%.
16%. I mean, that's an incredible number.
It's an unbelievable number. And the key was this was open to everyone. It wasn't just for nobles. A writer at the time, a guy named Rubies, he wrote that the demand was so intense that the very servants brought their savings, women sold their ornaments, and widows their annuities.
So everyone was piling in. They were running toward it.
Like running to a fire, as he put it. But of course, any mania built on the credit of a king who's constantly at war, well, it's not going to end well.
And it didn't. 2 years later, right.
Just 2 years. In 1557, Henry just suspended payments. The loan collapsed. It fell to an 85% discount, basically worthless.
And all those servants and widows.
Wiped out overnight. It's
Yeah.
maybe the first great lesson in sovereign default.
It sets the stage perfectly for the next big innovation. A century later, we shift to Amsterdam.
Right. Amsterdam becomes the financial capital of the world, and it's built on stability. They established the Amsterdam Whistle Bank in 1609, Europe's first central bank.
But the bank itself was super conservative, wasn't it?
Incredibly conservative, it paid no interest, and it only issued notes against actual gold in its vaults. But that rock-solid stability was revolutionary. It gave Dutch merchants a reliable currency they could use to settle bills anywhere in the world.
So you have this anchor of stability, But right next to it, human psychology finds a way to go wild anyway.
It always does, and that's where you get the Dutch futures trade, the one that powered the famous tulip mania.
He called it the wind handle.
The wind trade. Because the value was literally sustained only by air or wind. You weren't trading the physical tulip bulb.
You're trading a piece of paper, a contract.
A contract, exactly. The right to buy or sell that bulb months from now. That's where the leverage comes from. That's where the speculation gets really potent.
And people knew it was absurd, even then.
Oh, they knew. There are contemporary prints, like Flora's Carafools, that just mercilessly satirize the whole thing. They knew they were trading hot air, but they couldn't stop.
Okay, so from there, we jump to England, late 17th century, the financial revolution. And the weirdest part is that the catalyst for their stock market boom was a war.
A war with France in 1689. It interrupted all the foreign trade, which is where merchants usually put their capital.
So they were stuck with all this cash.
Exactly.
Yeah.
And they poured it into new domestic companies instead. It's a perfect illustration of that old market saying, achetez au canon, vendez au clairon. Buy at the cannon's roar, sell when the trumpets sound.
And that cash created a rage for establishing new companies, run by these guys they called projectors.
And some of the ideas were just out there. We're talking companies for convex lights, for street lamps, diving companies to find shipwrecks, a white paper company.
It was a full-on market. They were listing stock prices in periodicals.
Oh yeah, John Houghton's paper listed them twice a week. But the line between finance and just straight-up gambling was, well, there was no line.
You could just walk into a coffee house.
Like Edward Lloyd's, yeah, and you'd find underwriters taking bets on literally anything. The death of a famous person, the outcome of a battle.
I think my favorite one from the book was the assurance of female chastity.
Right, I mean, it was just a carnival of risk, and that carnival mindset leads us directly to the Great Bubbles.
The South Sea Bubble, 1720, the big one.
The prototype. The idea was that the South Sea Company would take over Britain's entire national debt.
Privatize the debt.
Essentially, yeah.
Yeah.
And money just flooded in from all over Europe, Paris, Hamburg, creating the continent's first international bull market.
And the absurdity level just went through the roof.
Completely. Hundreds of sham companies popped up, schemes for extracting silver from lead. My favorite was the proposal for building an engine to remove South Sea House to Moorfields,
Moorfields being.
the site of Bedlam, the famous insane asylum.
So they were basically saying the only logical place for the company was the madhouse.
That was the joke. And even the smartest guy alive got sucked in. Sir Isaac Newton.
He lost money on it.
A fortune. He got out early with a profit, saw his friends getting richer, jumped back in at the top, and lost 20,000 pounds.
Wow.
And his quote on it is just timeless. I can calculate the motions of the heavenly bodies, but not the madness of the people.
It really says it all. And that madness was contagious. There's that story of the doctor.
Oh, the doctor checking the pulse of an elderly patient. He's murmuring to himself, oh, good God, it falls, it falls.
And she thinks he meets her pulse.
She thinks she's dying. But he was looking at a stock ticker and talking about the Mississippi stock price, which was a related bubble crashing at the same time. The market literally mattered more than human life in that moment.
Unbelievable. So let's fast forward 2 centuries, 1929. The structures are more modern, but the psychology.
The psychology is identical. Before the crash, you have the exact same narrative. They called it the New Era.
The New Era fallacy. This idea that the old rules just, they don't apply anymore.
Right. They believed the creation of the Federal Reserve back in 1913 had basically abolished the business cycle. So growth would be forever, and any price for a stock was justified.
And the fuel for that fire was leverage.
So much leverage. That was the dominant feature of the 20s. Margin loans. You could borrow up to 90% of the stock's price.
Which meant anyone could play. They had that acronym, buy AOT.
Any old thing. It democratized speculation just like the Grand Party loan. You had guys like Groucho Marx borrowing $250,000 to play the market.
And the darling stock of the era was RCA, right? The new tech.
Absolutely. The Radio Corporation of America. Everyone believed radio was the future. That stock went from 75 cents to a high of $114 in 1929. Just pure speculative fever.
And when it finally broke, the crash scene itself is so surreal.
It is. Winston Churchill happened to be in New York on Black Thursday. He went to the Visitors Gallery on Wall Street, expecting to see just absolute chaos.
Shouting, panic, people running around.
But running and shouting were banned on the floor of the exchange. So instead, he described the brokers just walking back and forth like a slow-motion picture of a disturbed ant heap. just quiet, contained terror.
That's almost scarier. And the fallout was brutal.
Devastating. William Crapo Durant, the founder of GM, one of the richest men in America, was totally wiped out. He ended his life washing dishes in a restaurant.
Wow. After that, of course, came regulation, Bretton Woods. Things were tightened up for a few decades.
There were, but the pendulum always swings back.
And in the 80s, under the Reagan administration, it swung hard toward deregulation.
It did. The financial historian Robert Sobel has a great line on this. He said the old regulatory structure was allowed to decay, transforming the carefully regulated zoo of the 1950s into a jungle.
And in that jungle, new predators emerged. New products.
Chief among them, junk bonds. Debt from companies with low credit rating. Traders themselves called them toxic waste.
And this is where that concept of reflexivity comes back in, right? Can you walk us through that feedback loop?
Sure. So initially, the idea behind junk bonds was based on some sound analysis. It claimed they offered better returns for the risk.
Okay, makes sense so far.
But then, as they got popular, money flooded in. That flood of money validated the initial belief. It also encouraged weaker and weaker companies to issue more and more junk bonds.
Ah, so the popularity actually degrades the quality of the asset itself.
Precisely. The belief that junk bonds were a good investment drove their prices up, which made people believe it even more, which in turn caused the quality of the new bonds being issued to plummet until they became truly awful investments. The belief distorted the reality.
That is a terrifying loop. We also saw these unique cultural bubbles, like in Japan in the 80s.
Oh, the Japanese bubble was extraordinary. It was partly viewed through this cultural lens of Nihonjinran, this idea of Japanese uniqueness and invincibility.
And there was a lack of transparency, a sort of hidden reality.
Absolutely. The distinction between honne, a person's private truth, and teitmei, the public facade. In finance, that meant the Tokyo Stock Exchange was basically run by a cartel of brokers.
So it wasn't a real market.
Not really. They would guarantee returns for big clients. If a favored client lost money, they'd give them what they called ambulance shares, stocks that were guaranteed to go up to make them whole again. It was a closed loop for insiders.
So across all these stories, from Roman seekers to Japanese ambulance shares, the one constant, besides the madness, is speed.
The speed just becomes exponential. The stock ticker in the 19th century made crises faster. Then automated trading in the 20th century sped it up even more.
It's why a guy like George Soros, a hugely successful speculator, was calling for regulation of giant hedge funds back in the 90s.
Right. Soros warned that there is an innate instability in unregulated markets. And that brings us right back to the beginning. It's the same forces leverage, a belief in a new era, and the collapse. The human element is the constant.
So when we wrap this all up, what's the big takeaway for you listening to this today? I think it's that speculation is this timeless story. It always has the same features. Leverage, this intoxicating belief that this time is different, and then the psychological break when reality bites back.
And it's almost never about logic. It's about psychology and narrative. John Maynard Keynes had that famous line, "Practical men who believe themselves to be quite exempt from any intellectual influences are usually the slaves of some defunct economist."
That is the perfect way to put it. The South Sea speculators were slaves to the idea that state debt was infinitely valuable. The 1929 crowd were slaves to the idea that the business cycle was dead.
So the question to leave you with, as you look at our own financial world today, with its own new technologies, its own leveraged bets, its own new era stories, is this. Which defunct or historical assumption are you currently a slave to? Is it that markets are always right, that new tech can defy old rules? Or that this time, finally, the patterns of history won't apply?